This is Alan Bush with ADMIS with the daily financial forecast for Tuesday, May 3rd. Starting out with the stock index futures, we are seeing prices under some pressure today. This mainly due to news that a gauge of Chinese manufacturing came in weaker than expected. So with pressure this morning, some stops being hit, but we do believe that there will be some recovery this afternoon. Still thinking that any bearish news should be used as a buying opportunity and that the main trend for the stock index futures is still higher. In fact, we do think that indices will be able to trade higher for the entire year. Now, moving over to the currencies, seeing the dollar index under some pressure again today, and traders rather surprised, at least traders on the floor, concerned that the dollar has been so weak, even though the Fed is still the only major central bank that is likely to raise interest rates this year. But what has happened is the anticipated rate of increases in interest rates from the Fed has slowed. If you recall, it was last December that the Fed said that they could raise 4 times this year. Then earlier this year, the Fed said they could raise 2 times this year, while the financial futures markets are now predicting that the Fed may be only able to raise rates just 1 time this year. So all of that appears to be the main reason why the dollar has been so weak in the face of prospects of at least 1 rate increase later this year from the Fed. Now, we are seeing some pressure in the pound, and a measure of UK manufacturing did come in weaker than expected. Also, the pound remains vulnerable at these higher levels, at least higher over the last month or so, with the UK referendum to leave the European Union scheduled for June 23rd. So any turn in the polls to the leave camp could make the pound very vulnerable to a rather severe sell-off if that were the case, if there is a change in the polls. Also, we are seeing the yen advancing to an 18-month high. This due to the Fed that is apparently slow to raise rates, while the Bank of Japan is apparently very slow to add more stimulus. So that is the recipe for higher prices for a currency, and of course the yen advancing to these highs. Now, moving over to the interest rate futures markets, prices higher across the board. Much of this linked to the Chinese weak economic news. Also, stock indices lower, crude oil lower, all of which contributing to higher prices for the credit markets. But we do believe that inflation around the world, at least core inflation rates, are increasing. That should be viewed as a longer-term negative. So we're tilting a little bit to the bearish side longer term for the interest rate futures markets, especially the 30-year bonds. Also, in the precious metals, yesterday we did see a move to 16-month highs for the gold and the silver, and this move, we believe, is in conjunction with our view that inflation, at least core inflation, is increasing globally. So the precious metals, we still believe, are in a bull market. Any weakness should be used as a buying opportunity. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.